Securing investment for your startup is a monumental achievement, but the journey doesn't end with a handshake. The term sheet, a foundational document, often contains clauses that might seem complex at first glance. Understanding these provisions is key to safeguarding your long-term vision. So, among these critical details, what exactly are drag-along rights? Drag-along rights in term sheets are a specific provision that allows a majority shareholder, or a group of shareholders, to force minority shareholders to sell their shares in the company under the same terms and conditions. Essentially, if a significant buyer emerges for the entire company, these rights ensure that all shareholders participate in the sale, preventing a small number of dissenting shareholders from blocking a beneficial exit opportunity. The core purpose behind drag-along rights is to protect the interests of the larger investors and the company itself, especially when a sale or acquisition presents itself. Imagine a scenario where a venture capital firm has invested heavily, expecting a clear path to an exit. If a minority founder or early employee holds out, refusing to sell their shares, it could jeopardize the entire deal. Drag-along rights provide the legal mechanism to compel that sale, streamlining the exit process and maximizing the return for the majority investors who often fund multiple companies with a clear exit strategy in mind. This clause aligns everyone towards a common goal: a successful acquisition. For founders, knowing how to navigate these clauses means being proactive during term sheet negotiations. You will want to understand the exact thresholds for triggering drag-along rights, such as whether it requires a simple majority or a supermajority of investors, and who exactly can initiate it. Additionally, consider whether there are any carve-outs or exceptions that might protect certain shareholders under specific circumstances. For instance, can a founder be dragged along into a sale that offers significantly different terms for their specific class of shares? Clarifying these details upfront can prevent significant headaches down the line. A valuable insider detail is that founders can often negotiate for specific protections within the drag-along clause itself. These might include provisions like ensuring all shareholders receive the same per-share consideration, often referred to as pro rata treatment, or that the sale is to a bona fide third party at a fair market value. Another important consideration is a minimum valuation threshold, meaning founders cannot be dragged into a sale below a certain company value. These elements transform a potentially intimidating clause into a more equitable framework for everyone involved. Ultimately, understanding drag-along rights means equipping yourself with the knowledge to make informed decisions and negotiate effectively. It is about recognizing that these clauses, while designed to facilitate exits for major investors, can also be structured to ensure fair treatment for all shareholders. By clarifying the terms and potential implications during the term sheet phase, you can ensure that your hard work and equity are protected, positioning your startup for future success and a potentially smooth acquisition.